Joey, mate, we've got another super special guest today. Good friend of mine, good friend of a lot of friends of mine, and big fan of her. She's a virtual mentor of mine as well. But Cate Bakos, welcome to the podcast.
Oh, that's an awesome intro. Thank you for having me. I did not realize I was a virtual mentor, but really thrilled to hear that.
Yeah, and again, a massive thanks for joining us on the podcast. Jordan and I regularly tune into your podcast on a weekly basis, and I know most of our listeners do as well. We're avid podcasters, anything to do with the property space, and you're very well regarded as a buyer's agent in the industry, and great kind of insights and tips that you've not only been able to distribute through your podcast, but also a published author as well. So really excited to have you on the podcast.
Oh, thanks very much. It's my pleasure.
So we're all currently in lockdown, even though we're all diversified around Australia. I thought I might throw out diversification because we're talking a property podcast. But we're back down to lockdown number 5, and I think you were just mentioning, briefly off air just then about how we're so used to what the impacts are and how to react to these sorts of things, and we kind of just go back into routine again. But in terms of the buyer's side of things, how do you feel they're feeling at the moment? Because obviously sort of lockdown 1 and 2 was quite dramatic in terms of, we can't do auctions anymore. We can't do inspections anymore. No one really knew what was going to happen. Do you still feel like that sort of doom and gloom about the market comes about when we go into another lockdown? Or do you feel like, people are starting to get used to this rhythm now?
Oh, Jordan, that's such a good question, and I can answer it wholeheartedly. It's a really stark contrast when we look at what happened with our big, long lockdown last year, even the first one, and this year. We're in 2 different environments completely. It's like we're on a different planet. And it's actually surprised me somewhat, because this is not a little snap lockdown to shake it off. And we've now been in lockdown for nearly 2 weeks, and our numbers are still up. So the way that the buyers are looking at it is there's a bit of frustration there, only that they can't get out and have a look at the properties that they're keen on. But the vendors are the ones that are a bit different this year. And I think it's the vendors that are setting the scene for limited panic, really. And the reason for that is vendors last year freaked out about the idea of not being able to sell and maybe the market crashing or turning for the worst. And we saw a lot of vendors bringing sales forward and having panicked Zoom auctions and taking the first half reasonable offer. And lots of sales took place before the planned auction date last year. This year, though, they're pushing them out. They're demanding their day in the sun. They're wanting to get maximum numbers of buyers through. We're seeing auction dates getting extended. And that's the biggest contrast. And what that's doing for buyers is also enabling them enough time to actually get through or to do their due diligence if they know that they're not under nasty pressure or having to do things sight unseen. So it's 2 very different environments. And really what underpins that is sentiment. We've still got a lot of positive sentiment, not just buyer sentiment, but vendor sentiment. Vendors are seeing that the previous lockdowns did experience a bounce back when we came back on, and sentiment improved. In fact, we've had one of the sharpest property runs that I've seen in a long, long time, and vendors are wanting to get their piece of that.
Yeah, just in kind of give a story what's happening over here in Sydney. I mean, we're kind of gone through an unusually long lockdown period for us, but I mean, I'm noticing the exact same thing. So give you a bit of insight. My great grandmother's property was just put on the market about a couple of weeks before we went into the snap lockdown. Scheduled auction date did not change. People were able to get through, albeit kind of in dribs and drabs, as you mentioned. But the auction went ahead last weekend. It was probably worth like 1.2 million this time last year, and it sold just under $2 million. Heated buyers. There were 20 people watching the auction. 8 or 9 registered bidders, and 4 of them competing really strongly for the property, albeit in a really unusual setting of Zoom. So, I mean, you pointed it out very clearly there. There's still plenty of demand from the buyers, and the vendors still commanding top dollar and getting it.
Yeah, absolutely true. And last year when we did have COVID hit our shores, we saw market sentiment and a reaction that was pretty negative and pretty fearful. And it really only lasted for a short period of time. And we saw the market bounce back. But once we got out of lockdown the second time around in Melbourne, when we were locked up for a long, long time, it really did rebound quickly. And I know that things were just going mad in Sydney. So we've got a stock imbalance, we've got super low interest rates. And I think buyers are just standing back saying the last couple of lockdowns haven't really deterred things, and I'm not going to get that golden opportunity like I was hoping I would. So I've got to make a move now as opposed to waiting for an imminent crash or a slowdown. And a lot of people thought when JobKeeper came off, they'd have an opportunity to buy with less competition, and it couldn't have been further from the truth. I think we saw the most heightened competition in March and April.
Yeah, it was almost a cliff the other way, right? It wasn't a cliff falling off the cliff. It was a cliff climbing the cliff.
That's right.
And Joey just touched on something there with like a Zoom auction. And I think, it's kind of like, I don't know, you tell me, Cate, has it been kind of like a brand new world trying to, inspect, negotiate and purchase on prices during these lockdowns? And what are some of the trends that you've seen? And do you feel like those trends have continued after or in between the lockdowns? And do you think they'll continue to go forward moving ahead? Or do you think it'll be more sort of business as usual once we sort of transition out of things completely?
I think the incredible thing about COVID is it's changed the landscape of Australian real estate forever. And not every single thing that has been forced upon us as a change will stick. There's always a degree of elasticity, but we will see some things remain. And what's been really interesting in our industry, not just for auctions, but for consultations and meetings, client meetings, vendor meetings, whatever it might be for agents, Zoom is really effective. You can have a great catch up with someone. You've got share screen and the aid of every program you need in front of you. You can schedule it for whenever. You don't have to drive across town and see them at 8:00 in the evening. You can switch on Zoom. It has revolutionised our ability to manage our own time and to deliver really meaningful meetings and bolstered up with information on the screen to our clients. So I think that aspect itself is permanent change. I think auctions, the beauty of them is that they're a theatrical event, and it's the agent's opportunity to demonstrate to a wider audience how effective they are as an auctioneer or as an agency. That won't change. That's always been a very valuable showpiece for any agent and agency. But Zoom auctions are most certainly a great alternative when you are facing lockdown, and particularly if you've got limitations on the number of people through the property. You don't have that on a Zoom platform. And I'm noticing here in Melbourne, when all of this started, the only people that registered on a Zoom call were bidders. So if there were 4 registrants, you knew that you're up against 3 others. These days, maybe a quarter or a third of them are actually thinking about bidding, and the rest are having a sticky beak. They might be vendors that are interested in seeing what it goes for, or friends and family. But we're starting to get the auction crowd on the Zoom platform as well. So there are a lot of things that are here to stay and here to stay forever. And naturally, there'll be things that go. But I don't think business as usual will ever be what it was. I think it's shaped us all, from preferences around what we want out of our houses to how we run consults and meetings to how we actually negotiate and bid.
Yeah, I've just out of curiosity, and obviously you've, I'm sure, been a part of many Zoom auction. Have you encountered or heard whispers along the grapevine of any kind of technical problems that have impacted any potential buyers?
Yeah, all the time, all the time. I often sit on a Zoom call and someone has a dropout, or you've got somebody with a kid or a dog in the background and it's wrecking everyone's audio. Or the auctioneer starts, and a lot of older auctioneers, and they might not be so tech savvy. They're yelling for their teenage kids to come and help them out. They might not necessarily go offline, but sometimes they're on mute and they don't understand why, or they're calling for bids, but they've muted everyone and haven't unmuted them. We've seen it all. There are lots of tech.
I do wonder whether there is any, like, say, for example, you've got the old bloke down the road that's used to rocking up to an auction with his checkbook and paying for the property in pure cash. I wonder if there are any kind of buyers that are just purely not going to go because they don't have the technical capability of being on that platform.
No, agents are pretty good at making sure it's a very inclusive process, even if it means that they've got someone on FaceTime and the agent has registered on the Zoom call and has the phone held up. There are lots of ways around this, and I think what I've seen done really well is the ultimate, inclusiveness and really strong communication. Some of the worst platforms I've been on are auction platforms that aren't Zoom. And I had a situation when I was bidding on one late last year, high stakes, clients are there in the background. I could see everything on the screen. And when I went to press the buttons and put in my bid, which is a bit like eBay where you press enter and it uploads it, my buttons weren't working. I don't know what was going on. I didn't have a voice. It wasn't an audio platform. It was click the button and put in your bid. And I panicked and called the agent's assistant. And of course, they were there with, they were the IT help desk, and they took my call and I just bid through them. So it was a phone bidding exercise. It was incredible. And, that definitely makes your heart pump a bit harder, but there's ways around everything. I think some of these auction platforms can be difficult for people, but auctioneers and agents are very good at getting the full team on deck and providing, help desk and super good service when we need them.
Yeah, you're right. You touched on something really important there. Like the auctioneers love that theatrical performance, and that's really what it is. And it was funny because I was thinking about, the other sort of real estate agents that will walk up to you during the auction and try and encourage you, entice you, or, come on, how are you feeling? Do you want to make a bid or whatever it might be? And I was going to say you generally don't get that with a Zoom auction, but if you've got the phone on hand, and I guess they're IT support, but you still can talk to someone if you want to throughout the process. But such a different world. And I guess that whole theatrical thing leads into, ultimately what the price of property comes to, right? Like all those emotions that get pulled during the strings, and your strings of emotions that get pulled during the sessions. And I think that kind of leads into what is the price for property? Like what should you be paying for property? And sort of given your experience, Cate, and exposure to all sorts of markets and all types of properties, I mean, from a personal point of view, what do you think would be your philosophy around property investing over the long term? I mean, you don't necessarily have to dive into all of the fundamentals that you would you do a due diligence for your client, but what would be some of the sort of really high level personal philosophy things that you look for?
Yeah, when you're devising a strategy, you've really got to work out what your strategy is. And when I say strategy, I'm a buy and hold strategist. That's what I've personally done for myself. Buy and hold means that I want to hold these properties into perpetuity and have them pay themselves down so that when I retire, I've got an unencumbered asset delivering me a rental income. That's not the only way to build wealth, though. It depends on what your appetite is for several properties, maintenance, all of the things that go with property, and whether your plan as you get into retirement is to have another asset class at your fingertips. You might choose to go into shares. So you've got to look at what you want in your retirement, how long you've got until your retirement, and what your ability to service debt is while you're working. And all of those things will deliver you a set of options. And for some people, if I've had a high income earner, for example, who said to me, I want to build wealth really quickly, but I want to retire in 10 years. So let's say they're towards the end of their working life. I'm in a different situation personally than what they are. If they've got a really high income and they can sustain negative cash flow, we can do something quite aggressive with capital growth assets, and then they can deal with the CGT implication and sell those down and channel the money into shares or whatever it is that they choose to. But if I've got someone who's approaching the end of their working life and they don't have strong cash flows, but let's say they've got a lot of capital at their fingertips, they might go into cash flow properties that will deliver them that rent. So everybody is different. And that's the first thing I always say, get your strategy right at the start. If you don't know how to do that, talk to someone who can, whether it's, someone with a QPIA qualification or whether you've got a property planner at your fingertips. You really need to know what your strategy is. And then the other thing I'd say is don't look at the micro movements. You're doing this for long-term. Property is a long game. And if you're trading in and out of it and losing your mojo every time there's a market correction, you'll waste a lot of money on stamp duty and agents' fees. So you have to back yourself. And the longer you are in the game, the more linear the chart starts to look when you take a step back. It's a bit like those impressionist paintings. When you get up close, you can't make much sense of them. But when you stand right back, it all starts to come together and looks like a clear chart.
Yeah, really interesting that you kind of mentioned, and definitely accurate in that there's no kind of one size fits all, and it is very customized to where the individual is that in their own stages of life, their own, as you mentioned, risk appetite for a certain level of debt. But it's great to know that your horizon is kind of similar to Jordan and mine, and that's kind of forever, to just allow you those options. But you mentioned a really, really important aspect there as well, and part of the reason why both Jordan and I love property as an asset class, the fact that there aren't those kind of daily market check-ins like there are the share market. I can go and open my like ComSec little account and check, oh gee, we lost 0.2% today. Imagine there was a little kind of ticker above every single property in Australia, how kind of more liquid the market would be. But it's not kind of subject to any of those margin calls. Evaluations are done really kind of sporadically for refinances or purchases. Other than that, it's kind of just sit and forget and worry about it in 10, 20, 30, 40 years time.
Absolutely. And the one thing that I find so impressive about property investing is when people start young. And the earlier you can start, the more time you've got on your side, the more forgiving the asset class is. So if you buy a B grade property and you weren't so wrapped with it and you've held it for long enough, eventually it will deliver for you. It might not outperform it. You might look back over your shoulder and say, well, had I chosen an A grade, I'd be this much more in front. But the interesting thing is how forgiving it is, and just how the power of time, really demonstrates its worth after you've held something for long enough. And I say to anyone who's, under 30 and thinking about getting into property, you will not know it now, but you'll look back when you're in your 40s and 50s and just realize with compounding value growth, how incredible getting in early is.
Yeah, you're so right. We did a little exercise a couple episodes back about the compound effect. I won't go through it again, but it includes you doubling your fingers. Anyway, you touched on a really good point there about a B grade property. And I guess when we think about sort of different grades of properties and asset classes, one of my biggest frustrations that I hear people say that are in the space is, I got this bargain, or I bought this property under market value. And I think there's a common misconception around, getting a bargain or buying under market value compared to, getting a really good A grade asset. So what would your views or thoughts be around, buying under market value versus buying really well?
It's a great question. Pete Kalezos coined my favorite phrase in relation to this. He's one of my fellow podcasters. And Pete said, buying a bargain, you want to make sure you've got a good bargain because you've bought really well, not because you chose something that is discounted. He said it's sort of like a bag of rotten apples. You can buy rotten apples really cheap, but they're rotten. And it was a great saying, because I've just pictured the rotten apple every time I think of a bad bargain. and buyers need to be really careful about that. If you're deliberately going for bargain properties that are compromised, if that compromise can't be fixed, you're making a mistake. If that compromise can be fixed and you're the person to do it, then happy days. And that might be that it's a property that really needs a renovation. It was a bit trashed or whatever. But if it's a property that has attributes that lenders will always frown upon, or buyers will be quite dubious about or choosy about when the market isn't as crazy as it is now, you could be stuck with a bit of a dud. And it's not just about its value growth and what you can sell it for. It's also about whether a tenant wants to live there and wants to consistently stay there and pay the right rent. So bargain properties, it's either a situational bargain, which is great. It means that you did really well because of the situation and the circumstances around the sale. But if it's a compromise bargain, you've definitely done yourself a disservice.
Yeah, maybe a pretty good segue into the next question. So it's really what I'm kind of gathering from your response there is that it's super important to make sure that we're buying a quality asset. So in your years of experience, what do you define as a quality property?
I'm going to go counter to what I hear some selling agents saying. Every now and then I'll get a phone call from a selling agent saying, I've got this great property. It'd be a really good investment. Often that means it's a really poor property to sell and it's hard to get off their books. So a great quality property is one that has really strong owner-occupier interest and, broad across the board interest. And the reason for that is that the more mainstream the property is, the more people that are attracted to it and the more emotional they feel about it, the more they'll be prepared to pay for it. And that means when you go to auction, you'll face competition. But it also means that as you hold this property, into the future, other similar properties in the same location will attract really strong buyer interest, and they'll have emotional bidding. And they're the recent comparable sales, if you like, that underpin the growth of the one that you hold. So if you've got a property that, just gets everyone's hearts pumping and gets bidders bidding emotionally, you know that it will serve you well into the future. It can't be quirky, weird, and it can't be too odd a property for mainstream appeal.
Yeah, there's some great points and definitely some good stuff to keep note of and be aware of when you are sort of looking and sourcing for a property. And I think, this is kind of one of the reasons, and I mean, we've touched on many of the reasons today why you are such a virtual mentor of both of ours. You constantly go on about the same fundamentals in your blogs and your podcasts, and that's why we absolutely love them. But why have you been able to sort of hold this composure or long-term view of these fundamentals in property over the long term, and what encourages you to continuously get that message out there and make sure that it's distilled to people who are in this space?
Wow, that's a big question. It's a good one, though. I think about the fundamentals of things, the evergreens that don't change. My advice piece on these particular elements won't be affected by, legislative changes or tax policy or any market trends or fashions and fads. That the one that is really underpinned in a lot of my blogs, and it's a constant message, is land to asset ratio. And you guys will be familiar with this. What it means is a proportion of the value of the property that is apportioned to land versus dwelling. So, for example, if we talk about houses, that keeps it a little bit easier than units. Let's say if you've got a house and land package and the house itself costs more to build than the land cost to buy. Well, that particular property will most likely underperform, and it might even go backwards in value. And the reason for that is the land will appreciate at a certain rate, but the dwelling will depreciate likely at a greater rate. And so your land to asset ratio is a percentage figure. And if it's up around 80%, it implies that the land is going to do a lot of the heavy lifting. If it's up around 95 or 100%, it means that the house is in pretty dire condition and its value is limited to zero. And you can have a lot of grief as a landlord if you've got a house that sits on a piece of land that's valuable, but the house itself is only representative of 0 to 5%. So it's all about striking that balance, and there's no perfect number, because some people are happy to turn their hand to doing a little bit of a reno, and some people can afford a really strong land content price point. But that one definitely underpins some of my fundamental beliefs. The other one harks back to my time as a mortgage broker, and that is I don't want to buy anything that banks don't like. Because if the bank doesn't like it, even if it tolerates it, or if you've got cash to pay for it, it means that selling it will be problematic. And it also means that comparable properties will underperform because they're hampered by the same constraints. And they're, again, the properties that underpin the value. So they're probably the two that I really live and die by, other than the fact that no property is perfect. We expect properties to have a 100% scorecard, but they're like people. They're all unique. They're so individual. You'll never get two identical properties. Even if they're super similar, they're never identical, unlike a parcel of shares. So I think we have to treat property with that level of respect, that they're also unique, and there's a lot of subjectivity as well when it comes to appraising, assessing and liking a property.
Yeah, and you mentioned something that I just want to point out as well. So going back to the land to asset ratio, and it just highlights the importance of understanding who you are as an investor as well. Like, for example, you've got people with the cash flows that can afford to land bank, right, with zero income coming from the property, and maybe a fabulous parcel of land, and it might be appreciating it 10% per annum, and which is fabulous, but there's no dwelling on there. But that's not achievable for everyone, because most of the investors who we've had on the podcast, and most of our kind of generation, definitely need that cash flow coming through. So one thing to kind of point out there, but also a segue into the next question that I wanted to ask, and that's the often debated topic of buying for cash flow versus buying for growth, which can be a win, and how do you kind of see that debate?
I love this debate, and I often get wheeled out to talk about the merits of cash flow. And it's not because that's all I believe in, but it's because I think a lot of buyers agents and a lot of strategists overlook the benefit of cash flow. And for a lot of people, it's a part of balancing their portfolio, and for others, it's their only option. And when you contrast the two, if you had a property investor who had the income to sustain a very strong capital growth portfolio, and then you grabbed a cash flow investor and ran the same numbers, you'd see that long term the capital growth comes out in front, but not everyone has that option. And also, if you look at borrowing capacity and lenders' appetites for giving more money out to someone who is highly leveraged, you'll hit your borrowing capacity limiter before you start to feel that your purse strings are being snapped shut by your own expenses. So the banks have to buffer things, and they're a bit more conservative than a lot of investors like to be. So you have to balance it up, because if you go hard with your capital growth, you'll eventually have the bank say, no, you can't borrow anymore. And if you haven't got enough properties under your belt to start paving out a retirement strategy, then you've really done yourself a disservice. If you can balance it, you can demonstrate to the bank that you've got an income that's a little chunkier than what it would be if you had all of these cash flow shortfalls. So there is merit to both. Personally, though, I've embraced a combination of capital growth and cash flow for my own portfolio, because I've mapped out when all of my debt retirement will end, and when I'll have unencumbered properties, and I'll have options and choices with what I want to do with my days. And I joke about that now because I love what I do and I can't imagine stopping, but it's nice to know that you've got choice. So for me, if I just went capital growth all the way, I'd be in a very different position, and I would be working for a lot longer. I'd be forced to work for a lot longer to pay down a lot of debt. So you really have to run the numbers, and a good strategic mortgage broker can help you pave that out if you're working off, reliable and realistic capital growth figures into the future. You can pave it out.
Yeah, one of my favorite property podcast episodes, like I probably listened to over 1,000 property podcasts, I reckon, in my time, but actually one of my probably top 2 or 3 would be the debate that you had on your podcast, and you took the cash flow side of things. It was phenomenal, and like there was strong arguments for both cases. And I think it was a combination of that and going through COVID that actually flipped my thinking, because I was very sort of strong capital growth for a long time, and still am. Like fundamentally, as a base or building out the portfolio, I'd always kind of go for growth first over cash flow. But there is a point in time where if you can't sustain these portfolios, if there's a loss in income, or you put into a situation where you can't afford to hold on to these things and you had to sell them in the worst case scenario, then all of those profits and gains and everything else is kind of gone to waste if you're in a position where you had to sell it in a situation where you didn't want to, or in a market that wasn't suitable to do so. So it's definitely a good argument to say, like, you run the numbers and really understand where you stand, how the banks stand about it, and take that sort of long-term view and understand where, as you perfectly pointed out, Kate, where is that time where you can switch over, where you're going to have unencumbered properties and have that lifestyle decision if you wanted to retire, if you want to keep working, and really understand those numbers behind the whole strategy overall. But I guess
I couldn't agree more. I had a friend ask me the other day about 2 properties that she bought 12 years ago. And she said to me, I'm a bit disappointed they've underperformed. And I said, what do you mean they've underperformed? They haven't grown heaps. I've seen other properties that have grown more. Okay. So when we first talked about this particular strategy, what you wanted was set and forget. So you wanted something that didn't demand that you fed a shortfall. You wanted it to cover itself and just be a little bit positive so that you could bank away some money for repairs, etc. And you wanted it to be consistently rented out, and you wanted to see rental growth. Now, the property has done exactly what you've asked for of it. It's delivered you consistent rental returns. Your rents have grown. It continues to be in an area where there's an undersupply of rental housing, and it hasn't cost you any shortfalls, and you've been paying principal and interest for quite a while now. So presumably you're getting closer to retiring this debt. I actually think your strategy's delivered. And it was a really good conversation, because if we hadn't looked at it objectively like that, she might have been feeling like it had underperformed and let her down, but it wasn't the case at all.
Yeah, cool. And in terms of, I guess, wrapping up that overall picture and fundamental growth, cash flow, what defines a good quality property? And I think, you know, one of the biggest things that excites me about your episodes is the golden nuggets at the end of every episode I hang out for them. So I know there's probably 101 things that you could say right now, but if there was just 3 sort of big picture fundamentals that you would distill someone who is starting out on their journey, what would they be?
First and foremost, start young. Second, always have an offset account. And third, be patient. Don't watch the micro movements.
I love it. I love all of them, especially the offset. That's a big one. I'm glad you said that. And I love that you took a different route than sort of like fundamentals from a property. Like it really is, you know, we commonly say it like the game of property is really a game of finance. And if you don't have an offset strategy or you don't even know what an offset is, you know, you should really understand what the benefits are and how they can move you forward. So yeah, I love it. Joey?
Yeah, we haven't really heard those 3 before, so they were really interesting. And it's great to have a couple, even that one just around mindset, which has got nothing to do with the kind of, doesn't have nothing to do with the property space, but it's not directly property focused. And that's one that I could definitely take myself. I'm quite impulsive. So one that you need to always stop, put on the brakes and kind of let time do its thing rather than being so aggressive 24/7. But yeah, really, really kind of impressive and ones that we haven't had before. So thanks so much for sharing that, Cate.
I'm glad. Try and keep you fellas on your toes.
I guess what that what experience brings, huh?
Look, I've been an investor for more than half of my lifetime now, and it is important to just step back and let it do its thing. Sometimes when you just forget about it and stop monitoring its movement all the time, you get a fantastic surprise when you turn around and have another look a couple of years later.
Yeah, I suppose that's the problem with kind of our generation and demographic, Jordan, is that maybe we are a little bit too, we're the afterpay generation, right? Like we want everything now, and we'll worry about the rest later. And there's not many within our generation that are kind of that plant a seed now, water it and let it grow into a tree 20, 30, 40 years down the track. So it's what we're kind of on a crusade to do, try and spread the message to our peers and hopefully plant that seed within someone's brain to kind of go, yep, maybe I do need to take a step for my future.
Well, it just seems to be getting worse with the instant gratification. Every day there's something new that we have to get quicker and faster and pay for straight away and everything else. So you're spot on there, mate. But Cate, it's been phenomenal. It's always phenomenal. We really appreciate your time coming on, distilling some really key fundamentals to all of our listeners. I'm sure, I even got plenty out of today, and I'm sure all of our listeners would have got plenty out of today. So thank you again so much.
My total pleasure. Thanks for having me on the show.
Thanks so much, Cate.